Chapter 7: Portfolio Policy for the Enterprising Investor, the Positive Side. What if the best investment opportunities are usually the ones nobody gets excited about? Not the flashy companies, not the viral trends, not the investments everyone is posting online, but the overlooked ones, the ignored ones, the uncomfortable ones, the undervalued ones. Benjamin Graham believed intelligent investors could sometimes find extraordinary opportunities precisely because human emotions create irrational pricing. Because markets are not always logical, sometimes fear pushes prices too low, sometimes excitement pushes prices too high. And in Chapter 7 of The Intelligent Investor, Graham explains how enterprising investors may benefit from these emotional market mistakes. But there's a catch. This strategy requires something many people struggle with: patience and emotional independence, because intelligent investing often feels emotionally uncomfortable in the short term. Part 1: Why the market misprices things. Benjamin Graham believed markets are influenced heavily by emotion, not just facts. That means prices do not always reflect true value immediately. Sometimes investors become overly optimistic, sometimes they become overly fearful, and during emotional extremes, prices become distorted. This creates opportunities for enterprising investors. For example, a company may experience temporary bad news, economic fears, negative headlines, industry pessimism, or public disappointment, and suddenly the market reacts emotionally. Prices fall aggressively. Now, sometimes the market is correct, some businesses genuinely weaken, but other times, fear becomes exaggerated. And Graham believed intelligent investors could potentially identify situations where price falls further than actual business value. That's the foundation of value investing, looking for the difference between price and intrinsic value. And honestly, that sounds simple emotionally, but in reality, it's psychologically difficult, because buying unpopular investments feels uncomfortable. Part 2: Why unpopular investments feel scary. Human beings naturally seek social confirmation. People feel emotionally safer when crowds agree with them. That's why buying popular investments feels easy. Everyone sounds optimistic, everyone feels confident, everyone celebrates gains. But enterprising investors often look where fear exists, and fear creates emotional discomfort. Imagine buying a company while headlines are negative, public opinion is pessimistic, and investors are selling aggressively. Most people emotionally avoid situations like that. Why? Because emotionally, humans confuse popularity with safety. But Benjamin Graham believed markets frequently overreact emotionally, and overreaction can create opportunity. Again, not recklessly, not blindly, but rationally. The enterprising investor asks, is the fear temporary? Is the business stronger than current emotions suggest? Is the market exaggerating short-term problems? That mindset requires emotional discipline, because markets may remain pessimistic for long periods. And honestly, many people emotionally give up before value is recognized. Part 3: The Importance of Patience. One of the biggest themes in this chapter is patience. Because even if an investor identifies an undervalued opportunity correctly, the market may not recognize it immediately. That frustrates many people emotionally. Modern culture trains people to expect instant results, instant growth, instant validation, instant success. But Graham believed investing often rewards delayed gratification. That means intelligent investors sometimes wait months, years, or longer for value to become recognized. And emotionally, waiting is difficult, especially when other investments seem more exciting. Social media celebrates fast profits, and trends constantly distract people. This is why emotional discipline matters so much, because many investors abandon intelligent strategies simply because results are not immediate. But Graham believed markets eventually correct extreme mispricing over time, not always quickly, not perfectly, but often eventually, and patient investors may benefit from that process. Part 4: Why Emotions Distort Prices. Benjamin Graham repeatedly emphasizes something timeless. Markets are driven by human psychology, and psychology fluctuates constantly. Fear exaggerates problems, greed exaggerates optimism. This creates cycles. For example, during strong markets, investors become overly confident. They stop focusing on valuation. They assume growth will continue forever. Prices rise emotionally. Then eventually, something changes. Fear appears, confidence weakens, panic spreads. Suddenly, investors become overly pessimistic instead, and prices collapse emotionally. Graham believed intelligent investors should recognize these emotional swings instead of becoming controlled by them, because emotional crowds often create irrational prices in both directions. Again, this requires emotional independence, not arrogance, not stubbornness, discipline, because enterprising investors must still analyze carefully. Not every falling stock becomes a good opportunity. Some businesses genuinely fail. That's why Graham emphasizes rational analysis repeatedly. Emotion alone is not enough. Optimism alone is not enough. Fear alone is not enough. Intelligent investing requires thoughtful evaluation. Part 5: The difference between investing and gambling. This chapter also quietly warns investors about confusing speculation with intelligent value investing. Some people hear, "buy unpopular investments," and suddenly begin gambling emotionally on collapsing companies. That is not Graham's philosophy. He is not encouraging reckless risk-taking. He is encouraging rational opportunity recognition. There's a difference. The enterprising investor studies financial strength, business quality, valuation, long-term survival potential, not emotional fantasies. And honestly, this distinction matters enormously today because many people confuse risky speculation with high-level investing. But Graham's philosophy remains disciplined. He believed intelligent investors seek value, preparation, analysis, and margin of safety, not emotional thrill-seeking, because eventually speculation driven by excitement often collapses emotionally, while disciplined investing survives longer. So what's the deeper lesson of Chapter 7? Opportunity often appears where emotions create distortion. Benjamin Graham believed intelligent investors could sometimes benefit from fear, pessimism, and temporary market overreactions, but only if they remain patient, disciplined, rational, and emotionally independent. Because successful investing is not about constantly chasing excitement. It's about recognizing value calmly while others react emotionally. And honestly, that mindset may be one of the rarest financial skills today. Next chapter, we'll explore one of the most famous ideas in all of investing, Mr. Market. Benjamin Graham's powerful metaphor explaining why markets behave emotionally, and how intelligent investors can use emotional market swings instead of becoming controlled by them. And honestly, this chapter alone has changed how millions of people think about investing forever. See you in the next chapter.